I've been investing for about 6 years now, and during that time, I've worked with some very experienced traders. Some of these people have been investing for over 20 or 30 years and have built multi-million-dollar companies from the ground up. I consider myself very fortunate to have made these connections and to glean at least a little bit of what they know. While it took some time to fully comprehend the strategies that they laid out for me, it was worth it to study them and truly understand, because before that, people told me to do research when investing, but I didn't really understand how. I'd look up the name and the price, maybe read a news story or two, and then just throw my money in there hoping that it would do well. And sometimes it did do well. When I first started trading stocks, I bought some Amazon for around $500. It grew to $1,000 and then I sold it. But this is when the problem started. I made a few good trades and then I jumped into riskier investments. This is also known as having a hot hand in gambling, and a lot of novice investors fall victim to it. They make some good trades, maybe they're up 20, 30, 40%. Then they decide, okay, I'm doing pretty well at this. Let me see if I can day trade now. Let me see if I can triple my money on this penny stock. This almost never works because what beginner investors do not understand is the mechanisms that control the price of the asset they are purchasing. It is impossible to make informed investment decisions without this information, and that is what we're going to talk about in today's video. What I'm not going to do is tell you to buy any particular stock or cryptocurrency. What we're doing here today is discussing strategies that will help you research your own investments and make your own decisions. With that being said, let's jump into our first topic, which is the irrelevance of price per token. Most of my subscribers already understand the concept of market cap, but I need to include it in this video because it is so fundamental. Market cap is the core in which all other understanding of investment comes. When initially evaluating any investment, the first place I always look is the market cap. I barely take into account price per token. Price is a psychological factor entirely and almost completely irrelevant to growth. Only movement in the market cap is congruent with growth or gains. For example, let's say there's a cryptocurrency which is $2 a token and has a market cap of $1 billion. In order for the price of that token to double to $4, the market cap would also need to double from $1 billion to $2 billion. Movements in price are entirely dependent on movements in market cap. This is why as projects get larger, the price generally moves slower because it takes more capital to move that price. Fully diluted market cap also plays a role in this, but we'll get to that in a moment. Next, we need to discuss the importance of a long-term outlook. It is extremely rare that I will invest any money into a coin that I do not believe in long-term, even if I'm trying to make a short-term gain off of it. Because if the price goes down and I get stuck in that investment, I don't want to feel like I need to panic sell. This is a very common mistake for beginner traders, putting money into a coin they haven't done enough research on, then panic selling when the price drops 20% because they're not confident in what they bought. If you truly believe in a network long-term, you will never panic sell their token. I actually get excited now when I see the markets tank because it gives me a buying opportunity. So when you choose your investment, ask yourself, do I really believe in this thing? If we hit a bear market, am I okay being stuck in it? This brings me to our third topic, which is the art of averaging in and averaging out. This one is really important. It's not that hard actually. It's really quite simple. If I have $1,000 to invest, I don't invest that all at once. I average into a coin that I believe in long-term over a series of weeks or months. This not only helps me get a better understanding of the volatility patterns of the asset that I'm purchasing, it actually gives me a much better feel of when is a good time to buy that cryptocurrency. For example, I've been watching Doge for months after I sold the initial peak. I've been watching it slowly come down in price, and now during this market correction, I was able to pick up a bunch of Doge at 0.15 and 0.16. I have limit buys set at 0.14, 0.13, 0.12, 0.11, all the way down to 0.8, because even though I don't think Doge will actually dip that low, I might as well have those limits set just in case. If they trigger, then great, I buy down my average share price of Doge. If they don't, then fine, I still have that capital left to invest somewhere else. So I never try to time the highs or the lows all in one fell swoop. I don't take my $1,000 and dump it all in at once, nor do I pull it all out at once. I slowly average my investments in and then gently pull them out. You will never be able to time the peaks or the valleys perfectly. Nobody can. But if you can learn to average in and average out, I believe that you will be able to make consistent short-term gains in your long-term investment. For another example of this, when I first bought Doge at 5 cents earlier this year, I didn't panic sell it at 0.10 or 0.20. I may have sold a little at 25, 30 cents and sold a bunch at 0.40, 0.50, and 0.60. I used a similar strategy with my shares of Crypto.com, Decentraland, and Ravencoin. So now that we understand market cap, how to pick out long-term investments, and the art of averaging in and averaging out, let's move on to our fourth topic, which is the significance of fully diluted market cap. I harp on this point all the time, but it is absolutely critical to our understanding of how any investment is structured, stock or cryptocurrency. What we need to do is subtract market cap from the fully diluted market cap, and we are left with the total amount of uncirculated asset pending being sold into circulation. When these cold coins are minted into existence, it dilutes the value of the coins already on the markets, the coins held by you, the investor. For instance, if I see a network with a market cap of $1 billion and a fully diluted of $10 billion, I know that there are $9 billion worth of cold coins not yet accounted for in the price. So always look at the market cap in context of the fully diluted. Also take into account if the coin is hard capped or if there is a maximum supply. If a maximum supply is not announced, we need to understand why this is. For instance, in Dogecoin's case, the coins are minted on a certain schedule and distributed as block rewards to miners. Dogecoin's market cap is also equal to its fully diluted market cap, meaning that there are no coins held in cold storage. If we look at Hex by contrast, we can see that their market cap and fully diluted market cap are extremely disproportionate. There is a lot of coin yet to come into circulation. Sometimes we can rationalize out of the divergence in market cap and fully diluted if the project is really innovative. What it really comes down to is, do we think that blockchain is worth what they value themselves at? If the market cap is $1 billion and the fully diluted is $20 billion, we need to ask ourselves as investors, do we really think that this project is worth $20 billion? Do we expect the market cap to ever exceed that mark? If yes, then go ahead and buy, because if the market cap really does go from $1 billion to $20 billion, I'm going to at least break even if all cold coins are dumped into circulation. The point is to be aware of these mechanisms, not to be afraid of them. Some developers use them in really innovative ways to enrich their blockchains. Other developers use the cold coins to enrich themselves. On to our last topic, monitoring macroeconomic trends. This is a pretty simple one. It really just involves keeping up with world events and asking ourselves, what is the state of the world economy? Do we expect global economic growth to continue, or do we expect it to decline? This question is of course multifaceted, but here are some basic factors that I examine regularly. What was the last monthly jobs report like? What is the current level of inflation? What's going on in the Chinese economy, the sister economy to the United States in many respects? How's the conventional stock market look? What's going on with the supply chain? Are there any looming regulatory concerns? I try to keep up with these factors as much as possible on this channel, so hit that subscribe button if you want to see more content like this. But remember, don't get all your information from me or any particular source. Like we diversify our portfolios, we need to diversify our sources of information also. On that note, I want to give a shout out to Mining Office, Red Fox Crypto, and Red Panda Mining for their great contributions to the GPU mining community. I also want to give a shout out to Coin Bureau, Altcoin Daily, and the Game Report for their contributions to the crypto investing space. These guys have really good quality content, and they're a great place to start when it comes to gathering information about investing in crypto or investing in crypto mining rigs. With that all being said, thank you for watching this video. Go to mainblockchain.com if you want to check out my Cardano stake pool or any of the other projects that I'm involved in. Thanks again for watching. I'll talk to you all very, very soon.